Welcome to this quick little video on the what if scenario to cover the labor pricing for profit software. Many of you, after having gone through the Planning for Profit workshop, have asked me, if you remember, we walked through that scenario of doing the what if scenario, the what if process, if you will, of adding technicians, changing costs in your software. And you liked the scenario and you jotted the notes down, but you asked, is there any way that you could create something to just remind us? How do we do that step-by-step process for the what if scenario? So that's the goal that we have here. That's what we're going to be accomplishing today. So we're going to walk through a very similar scenario to what we did in the Planning for Profit workshop. We're going to add another technician to our company. So up until today, right, and the model that we'll be using here, just like in class, was we've got 2 service technicians right now. Right? Those 2 guys are really busy. I'm thinking that if I can add a 3rd technician, I can keep them busy. I've got enough work to do that. It'll enable the other guys to slow down just a little bit, not put in so much overtime, so I can keep a 3rd guy busy. Right? The question is, I don't want to raise my rates at all. I'm already at $135 per hour. I don't want to raise my rates any more than that because I'm already high in the market. I'm a little bit nervous about that one. So if I leave my rate at 135, am I going to be okay from a price standpoint? So let's kind of walk through the process just like we did in the Planning for Profit workshop. Right? So we're going to add a technician. And so the technician themselves, they're going to, we're going to pay them $25 an hour. Right? That's their wages, so that's roughly $50,000 a year that we're going to take on if we bring on another technician. As we go through this, we're going to give him 2 weeks of vacation. Right? So that's 80 hours of non-billable time that we need to add into our model as well. We're also going to give him 6 paid holidays. So that's another 48 non-billable hours that we're going to have. And since he's a service technician, again, most service technicians, typically, they're 50% billable, 50% of their time is lost. So out of his 40-hour work week, he's got 20 lost hours per week. Okay? So that's the technician themselves. Now, he's going to need a truck, isn't he? All right, so we have to get a truck. We weren't planning for that one. So we're going to buy a new truck. We can pick up a good truck for $30,000. That's our purchase price on it. And we're estimating that we can get 7 years out of that truck for life. So that's kind of how we're walking through this one. He's going to be selling some materials as he moves forward. So from a materials standpoint, again, that national average is a typical technician is going to use about $20,000 worth of materials per year at cost at 100% markup. So we're going to purchase $20,000 worth of materials. He's going to sell that throughout the year at a 100% markup average. Now, there's a lot more overhead that we're going to have to take on. It's not just the guy's wages and just the truck. What else are we going to have to take on? Right, if we think about it, we've got a couple of those items. I've outlined some of those here. Right? We're going to put the guy in uniforms. Right? So even if we have the laundering service, that's going to be $35, $40 a month at that point in time. You're looking at about $500 per year that it's going to cost you. We've got a number of insurances that we're going to have to take on. So in our particular case, we've got health insurance, and the company is basically paying $5,000 a year toward his health insurance. We've got workman's comp. That's going to increase a little bit. Right, so since that increases, we've got $2,500 a year in that. Liability insurance, that'll go up $2,500 a year. Again, might be a little bit different for you, but in our particular scenario, that's what we're going to increase. And then we've got insurance on that truck that's going to be on the road all the time. So that's another $3,000 there. We're going to do some training with this guy, and so we're going to build $2,000 a year into our model for training. And he's got communication. So cell phone, he's got a tablet. We've got the communications on the tablet. Right, so all that other stuff, we put another $2,400 a year in there for communications. On top of that, we've got to put fuel in the truck. Right, so this guy, it's going to be about $6,000 a year in fuel that we're going to have to increase. We've got to maintain the truck. That's another $1,500 that we've got coming in there. We've got some tools that we need to provide. Now, some of you vary. Some don't buy any tools for your guys. Others do buy the major stuff. They provide the small. In any case, we put $2,500 a year in there for additional tools that we have to buy. Now, since you accept credit cards, there's going to be some merchant fees. Depending on how much your customers use merchant fees, how much you as a company use merchant fees, that's going to be an additional cost that we have to factor in. In our case, we factor $4,500 in here for merchant fees. Also, we weren't planning on doing this at this point in time, so we didn't have the cash to buy a new truck. We had to take out a loan for the truck, and so we've got somewhere around $600 a month loan payments. And so that's an additional $7,000 a year that's going to come out of our cash flow. And we know we missed a few things. So as a result, we stuck $2,500 in there for just a little stuff that we missed. There's also other items in there. So we tally all these overhead costs up. That's another $41,900 in overhead that we're going to have to take on in addition to the guy, to his truck, all the rest of that stuff. So if we recap that real quick, we're going to be taking on $50,000 in wages because we're paying the guy $25 an hour. We're also going to give him 6 paid holidays, and we're going to give him 2 weeks of vacation. And 50% of his time, 20 hours a week are going to be lost. We're going to pay $35,000 for a truck, which we're guessing will last us 7 years, and we've got $41,900 in additional overhead that we're going to take on as a part of this venture as well. So how do we simulate that? Does it make sense for us? So I'm simply going to jump over to our labor pricing for profit software. I'm running version 6.00.34. And one of the first things that we have to do, again, if we remember, if we go up and we take a look at our reports in the software itself, first report I want to look at is the net profit analysis report. So it's going to crunch that data, and I can see that in my service department right here, I'm currently looking for a 15% net profit. And at 15% net profit, I need to charge $135.78 an hour. You see that right here. And if I do that, I'm going to have a total profit in my service department of $66,703. So we'll just make a quick note. $66,703 is our profit before. Now, if I bring on this extra guy, I better make a whole lot more than $66,000. Otherwise, I don't need somebody else to babysit. All right, so I want to look at that piece of the puzzle. And so what we're going to do is, first thing you need to do is, if you're set, your calculation method is set to a desired net profit, we need to change that, because if we leave it, in my case it's at 15%, if we leave it there, what will happen is as I add all this other overhead, it's going to change my hourly rate to get wherever I need to do to hit a 15% net profit. So in this particular case, I'm going to go into Modify Method, and I'm going to change my my rate here to, instead of a desired net profit, I'm going to change it to a current hourly rate. And I said I'm at $135 per hour. So we'll accept that. It will recrunch all of my data at this point, and again, still holds me in there at $135 an hour. I want to make sure that that doesn't change as we move forward. So at this point, we're ready to simulate and add these expenses. I'm going to close out this window, and again, it will ask you if you make that change. It's going to ask you, do you want to save this, the changes to these departments? We're talking about saving that labor rate, desired net profit to a labor rate change that we just made to $135. I'm going to say yes, I do. So let's go ahead and enter in our data. It's not too hard. We'll simply go back to the Setup menu, and I'm going to go into Costs Input. All we have to do is simply walk right down the line here with all of our cost types. So I'm going to start out with the equipment. I'm simply going to enter in a new truck. And so I'm simply going to call this Third Tech for each item. Right. It's going to be an existing truck because I'm buying it right now. We're starting out the model right now this year. We said it was going to last us 7 years, and we also said it was going to cost us $35,000 to buy that truck. And since this tech is in the service department needs to cover 100% of the expenses. So this will be 100% service. I can accept that one. We just entered in our third tech, that truck. We're going to build in $5,000 a year in equipment replacement costs to make sure that this makes sense for us. Now we can go to labor. So when I click on labor, on the cost types, again, I can simply hit New Technician. I'll call it one more time, Third Tech. We'll come down, just tab down a little bit. He's going to be hourly. We said he was $25 an hour. I need to go into the input hours. Remember, anytime we're dealing with technicians, our field labor, we have to go into input hours. And so we've got his full-time 40 hours a week in the regular hours column. We're going to go to the lost hours column right here. And again, we said he was going to be 20 hours per week lost. So it's 20 hours a week times 52 weeks. It will put in, we've got 1,040 lost hours. We also said that we were going to give him 2 weeks of vacation, so that's another 80 hours. And we'll plug that one in. And then last, we said we were going to give him the major holidays, 6 major holidays. what I'm going to do is I could go through the whole year and put them in by month. In fact, let's go ahead and do that. I've got 8 hours in January for New Year's Day. We've got Memorial Day. We've got the 4th of July. We've got Labor Day in there. And then we've got Thanksgiving. We got Christmas. There's our 48 hours that we're going to give him. All right, so we've just now done that. So out of his time, if we look at it, he's working full-time. Half of his time is lost. We've given him 2 weeks of vacation. We've given him some holiday time. And so ultimately, he's got 952 billable hours is what he's going to have. Again, does this make sense for me? We'll accept that. Last thing we need to do is we need to make sure that we allocate him 100% to the service department. We've just now added this technician. I can see, again, if you remember right here in the box, it's calculating this guy is going to be 45% billable. Ultimately, by the time we give him vacation, holiday time, and his 20 hours a week, 55% non-billable. All right, so we'll accept this particular technician. We now go to the next one, overhead. Right now, if you recall, when I went through the list of all the stuff that we were adding in terms of overhead expenses, some of those were fixed, some of them were variable. Right? We just kind of lumped them all together. We're not trying to project cash flow. I'm just trying to find out, does this make sense from a profitability standpoint? So I can just enter in a new one. Again, it's our third tech. Got him in. I'll spread the overhead monthly, starting in January. We said it was $41,200. Divide that by 12 months. All right, so it comes out to $3,433 a month in additional overhead that we're going to put in. We can spread it. Again, now remember, we've got the different methods to spread our overhead costs across. Since this is all service, I'm going to leave it at manual. And again, simply put in 100% service department. All right, so we've just added all that overhead costs. Next one down in line for our material types is the materials. All right, or cost types is the materials. Now, I could go in and I could just edit the service department number that's already there, but for simplicity's sake, I'm just going to go ahead and add a new one. Again, I'll just call it third tech. All right, we're going to spread this based on direct labor hours. It makes it a little bit easier. I said there was $20,000 a year at a 100% markup, and this is, again, 100% service. So we can plug that one in. We've just entered in all of those expenses that we've talked about. We've just simulated everything. So at this point, I can close out the costs input window, and let's go back to our reports. Remember, I've already locked in our labor rate to the $135 per hour. So when I run my net profit analysis report, it's going to crunch through the data again, and I can see at this point now at $135, my profit goes from $66,703 up to $109,000. My profit went from a 15% net profit to now a 17.94% net profit. So how does that happen? Right? How can we add all of these expenses and still make more money? One of the other things I would ask you is this. Did you catch the break-even rate? If you noticed it, prior to making these changes, our break-even rate was $113 per hour. Now, in the red box, we can always see our break-even rate. We're at $102.21. How do we add all these expenses and still lower our break-even rate? Well, if you remember from the workshop, one of the things we talked about, we've also, I think I mentioned the line, it's all about the billable hours. And if you look at our total billable hours that we have here, we're now at 3,347 billable hours, whereas before with two guys, we were at 2,300 billable hours. We've added that extra 900 and some billable hours, and when we add those hours, we're not just spreading this individual technician's overhead across those hours, we're spreading all of our overhead across those extra 1,000 hours. As a result, if there's more hours, the rate per hour, our cost per hour, drops. And when that drops, then profitability climbs. Now, this will always hold true. It will always hold true as long as one other thing stands firm. Now, again, we made the assumption, again, we know that I can keep this guy busy, right? We can bill out 50% of his time. We can bill out 20 hours a week. But there still needs to be one more thing that holds true in order for that to make sense. And that item is that I don't have to hire any additional staff inside to support the new guy outside. If I have to start hiring more staff inside, then the problem I run into is that overhead that we're taking on for that additional person eats away at all this increased profitability. And that winds up becoming a problem. So let's take this one step farther. What if I was wrong? Right? Again, we assumed that we could keep this guy busy, that we could bill out 20 hours a week. Let's say we can't do that. It doesn't turn out that way. We can check and see how bad this is. Right? So I'm going to close out this report for a second, and I'm simply going to go back to my setup and my cost input screen. And as I do this, I'm going to go into labor, and I'll find my third tech right here. Right? We'll modify that technician, and I'm going to go into input hours. And instead of 50% of his time being lost, I'm going to say we can only bill out 10 hours a week, not 20 like we thought we could. If all we can do is bill out 10 hours a week and we have 30 hours a week that's lost, right? Okay, 30 hours a week times 52 weeks, we now have 1,560 lost hours, and our billable hours go down all the way to 432. We're only going to bill out 432 hours for this whole year. All right, so let's accept that one. Right? So even if I'm wrong, right, I always look at it, if we're going to make a change, as long as it's not a mission critical change, we're okay. So let's see how bad this gets, right? I'm going to go back into my reports and rerun that net profit analysis report. When I run the net profit analysis, I can see that even in this case, at $135 per hour, I'm now at $39,000 in profit. So here's the thing. I took in all that extra overhead. Right? I'm not making the money I thought I was going to. In fact, I'm not making the money I was before. But here's the thing. It wasn't mission critical. Right? It's not going to kill my company. Remember, if you're pricing yourself out of our labor pricing for profit software, this $39,000 profit also means that as the owner, you're being paid. It means that you're putting money aside for trucks. This is what's left over after you've paid all of your bills. It wasn't mission critical. Do I like it? No. But it does also set me up for success in the future because now I have more bandwidth as I continue to grow my marketing and build this individual market. So it can absolutely help you. This process that we just walked through can be used for any overhead expense that you change. Maybe I want to buy another truck. Right? Add in the truck. See what has to happen to your labor rate. Right? So in fact, in this case, if I said, but I still want 15%, right? I could come back here to modify the method. Go back to a desired net profit of 15%. Even in this case, if I had a problem, I could raise my hourly rate up to $152 and still maintain a 15% net profit. Again, not optimum, but again, it wasn't mission critical to my company. I'm still okay. Hope this helps you out. If you have any additional questions in regard to this process or anything else in the labor pricing for profit software, please feel free to give us a call at Grandy & Associates at 877-202-8891 or visit our website at grandyassociates.com/LP for labor pricing for profit information. Make a decision to make it a profitable day. Okay. Cool beans. So, you got that video stopped?
Yeah.
Okay.
I didn't fade it because closing screen.
Yeah, and I don't have a closing screen, but that's okay. So the other one I want to do real quick, and there won't be any backgrounds. You know what? It would be nice to have that anyway. Maybe I'll throw together one screen real quick.